Good morning. Welcome to Friday's trading hour. Things are looking ugly on the market. 1% gone in the benchmark indices. The mid-cap index has fallen more than 300 points. 2.3% gone on the mid-cap index. Banks are under pressure, led by IndusInd Bank in particularly. And now the mid-cap index is down 10% from its recent high. So, entered into the correction zone. So it's just getting ugly, right? This whole week, we've hardly had any kind of a recovery. The recovery has been feeble and being sold into.
And this is something that we've not seen earlier. Earlier, every fall, we were seeing some buying on the dips. And this is the fourth time that we are seeing a 1,000-point cut on the mid-cap index in the month of October itself. We had that 985-point cut. So if we even add that, that's like 5 times that we've seen more than 1,000-point cut on the mid-cap index. And a lot of sectors and specific stocks which are seeing a lot of pressure. In fact, Hormaz has helped us with some data where they say some of the stocks which are down 20% and more, 12 stocks are down 20% and more. Between 10 to 20%, there are 46 stocks which are under pressure. Down 1 to 10%, around 30 stocks, and only 12 stocks are in the positive right now. So that's the kind of fall that we're seeing. The only green on the screen today is the FMCG index, which is gaining. But apart from that, look at the advance decline ratio. There are 2,200 stocks on the declining side versus 176 stocks on the advancing side. So mid-cap index, as Rima was pointing out, definitely under a lot of pressure, has entered the correction zone as well. And a lot of it is on the back of earnings as well. Steep reactions on earnings is what we are seeing. We'll be discussing them in greater details. The first stock on our radar is JSW Energy, reported a muted set of quarter two earn numbers. Revenues declined 0.7% YOY, while margin contracted to 52.6% versus 57.9%. Net profit remained flat, coming in at 853 crore rupees. Our colleague Vivek Iyer spoke to Sharad Mahendra, who is the joint MD and CEO of JSW Energy, to discuss more on the numbers. Listen in.
See, quarter two, in fact, in both ways for the country, for JSW, both has been a very happening quarter. Of course, demand part, when we say demand has remained muted, and there was a marginal growth of almost about 1.6% demand growth compared to Q2 of last year. The prime reason is we have to also remember that there was a significant growth of 11.4% last year in quarter two, which was witnessed. So this was on a higher base that we witnessed a growth of marginal growth of 1.6%. This was also driven by the extended monsoons across the country. So that was the prime reason that the demand growth was muted in the current year. But lot of activities which have happened in terms of the biddings which took place, if we recall that in first 6 months, country has again demonstrated what it was in the previous year, bidding of almost 22 gigawatt, which took place. And I'm happy to tell that almost 19 to 20% of this bid, JSW Energy, we have been successful in winning those bids.
Understood that, sir. So currently, what is the extent of untied capacity that you have at JSW Energy? And in Q3, how have merchant prices panned out? Has there been a recovery from Q2 levels?
We expect, Q2 normally what we witnessed, of course, there has been a significant drop in the merchant prices in Q2, which was to the extent of almost 30% drop in the prices realized last year, as compared to, because the availability was high and the demand was muted. So that resulted, but going forward with the manufacturing activities, which definitely see a uptick from quarter three onward and quarter three and quarter four. Normally the overall activities post-monsoon improves. So we are expecting the demand to start coming back again in quarter three. Definitely we expect it to be significantly better than what was witnessed in quarter two.
Understood that, sir. So in Q1, you had approved a fundraise of close to 10,000 crore rupees. We also understand this is for the wind turbine generation business. Now, along with that, we also understand that the Siemens Gamesa asset is actually on the block. Will you be looking at acquiring that particular asset? And what has been the update from Q1 as far as the WTG business is concerned?
See, coming to the WTG business, if we see that quarter two, when we talk of that, there was a all India capacity addition of almost 700 megawatt, which happened, out of which about 204 megawatt commissioning was done by us. And going forward, whatever capacity addition we are going to see in H2 of the current fiscal from our side, majority is coming from the wind assets only. Regarding the Cement Gamesa asset, what you asked, we normally don't comment on a particular asset, but as I have been saying earlier also, that any opportunity which comes in the market, we definitely keep evaluating, and as and when it is falling within our strategy and also protecting the benchmark returns, we definitely keep evaluating. That is what I like to say for this.
Right, sir. We also understand that you're constructing Asia's largest battery energy storage system with close to 1 gigawatt of capacity. How much of that is already tied up with SECI? What portion PPA is already being tied up? When will it be commissioned? And explain to us the economics of this particular BESS project.
See, this BESS project, yes, this is Asia's largest and among the largest, maybe top 3, top 5 globally. A single location, 1 gigawatt hour battery energy storage project. And I'm happy to tell that at site, the work is in full swing. And now we will start, the material will start arriving maybe in next 45 to 60 days time. And we are expecting the commissioning in H1 of calendar year 25 before June 25. And out of this, as we have said earlier also, that 60% of this capacity, we have received the letter of awards, and out of that 50% of the PPA has already been signed and balance is in progress. We expect very soon that PPA also will be signed, and rest all we will get the opportunity, seeing that the evening peak demand, the way it is increasing, we will be utilizing this balance 40% of the capacity for the evening peaks in the merchant market.
Understood that, sir. So let's now talk about JSW Neo. You did a significantly large fundraiser over there, almost 5,000 crores. Sometime in the future, any further value unlocking there? What are the kind of capacity targets that you've set there? And sometime in the future, is an IPO on the table?
See, maybe for future we'll not like to comment, but yes, what you have said that we in quarter one, in April of current fiscal, when we raised this funds, this was keeping in mind that we, as we have stated our strategy of strategy 2.2 of reaching 20 gigawatt by 2030 and 10 gigawatt by current fiscal, which is on track in the current year to reach the 10 gigawatt number. But when the opportunities, we see the change in dynamics in terms of the demands, the opportunity size increasing, storage also opportunities now taking pace. So we were seeing that we will be accelerating the growth. So these funds will be raised to reach that 20 gigawatt number significantly earlier than 2030. So that is where we'll be raising the funds. But as we say that whatever the capacity we have tied up, whatever the free cash we are generating, we will be in a position with this fundraise along with the operating assets, whatever the cash generation is happening, we will be in a position to meet and accelerate our timelines. So as and when, if any opportunity comes, we will be open. But right now, there is nothing that we will like to comment on that for raising another fund.
That's the conversation there. A quick programming note as we slip into a short break. As we prepare to ring in the festivities this Diwali, tune in to CNBC TV18 at 3 p.m. on the 29th of October to hear out the biggest market voices giving their tips on how you can make your portfolio prosper this Diwali.
Welcome back. You're still tuned into Trading Hour. Well, the pressure continues. Nifty Auto, that is down 3% right now. It's a big mover in terms of the sectoral moves that we are talking about. Nifty Metals is down 3%. We have the CPSE index as well, which is seeing a big fall. The Nifty is off around 300 points from the highs. And we are just 800 points away from the 200-day moving average on the Nifty. And that is something that we'll be tracking very closely. Some recovery on the lows from this, for the CPSE index. But still, if we talk about overall moves, it's a big cut that we are seeing across the board. And Midcaps, this that particular index is the big casualty today. 1,300 points gone on the Midcap index. But if we talk about sector-specific or stock-specific moves, actually, IndusInd Bank, that is the top Nifty loser today. The stock has tanked more than 17% on the back of weak Q2 numbers. Abhishek is joining us with the key takeaways.
Well, it's the weakest quarter that you are seeing from a lender that is in the banking space with respect to deterioration in asset quality and rise in credit costs as well, and operational weakness also over there. So net interest margin has come in at 12 quarter low of 4.08% when compared to 4.25% in the previous quarter. Operating profits, they have declined YOY for the first time in last 33 quarters. So operating profits have declined both YOY and quarter on quarter, the highest in last 9 years or even more, at about 7-8% quarter on quarter and around 9% on a sequential basis. So risk-weighted asset to advances ratio, that's at 7-quarter high, which means that the risk in the balance sheet has actually gone up. So it is at 117.7% when compared to 111.8% in the previous quarter. The profit growth rate decline on a YOY basis is the highest in last 33 quarters and sequentially the highest in last 18 quarters. So return ratios did get impacted and they are one of the lowest that you are seeing in last 4 years or 16 quarters. So ROA has come in at 1% and ROE at about 8%. Brokerages have cut the estimate on IndusInd Bank with respect to the earnings momentum going ahead over the next couple of years, anywhere between 14% to as high as 13%, and they have cut the target price as well in the range of 8% to 23%. We have the likes of Citi, Nomura, HSBC, Jefferies, MK who have cut the target price but remain a buy or give a buy recommendation given the fact that valuation as per them is attractive for investors. Back to you.
Okay, the stock is now trading, Abhishek, at 1.3 times forward price to book.
1.3 was as of yesterday.
As of yesterday.
So it might have gone to one, kind of a range. And if you take a look at other mid-cap banks as well, like RBL Bank, etc., all those who have high unsecured portfolio, their price to book value has got adjusted anywhere between 0.6 times to about 1 time.
Okay, but IndusInd Bank is still higher than that at about 1.4 times, I'm presuming, after the fall.
After the fall, it's gone down. It's now at 1x.
Okay, 1x now. And this loan growth guidance was earlier, I think, 18 to 22, 23% for this year, right? No, has that been changed?
No, not growth and all has been changed. They have not given out a guidance per se, but analysts have cut, giving the assumption that unsecured portfolio will continue to deteriorate over the next 2 quarters.
Okay, thank you very much for that. Let's get to the big mover then on the way up, and that's ITC top gainer, resilient set of Q2 numbers. Mangalam joins in with the fine print. Mangalam.
Well, it is resilience that has kept ITC higher. Resilience and a lot of underperformance of the FMCG pack. Have demand conditions changed? Perhaps not, but expectations have been moderated, and as a result of which the companies are beating these muted expectations. For ITC itself, there was a strong performance that came in their agri business, the hotels business, no taking away from that. Good growth on a high base. Remember, same time last year, we had the G20 summit as well. And on account of higher inflation in leaf tobacco, FMCG input prices, and the paper business weakness, margins were slightly shy of expectations, but the street is cheering top line growth this time around. Overall revenue coming in at around 19,328 crores versus expectations of 17,700 crores. The EBITDA came in at 6,335 crores. The street was working with a number similar to that itself, and the net profit at 5,078 crores, again slightly above street expectations of 5,050 odd crores as well. What was good was that there was cigarette volume growth that came in at 3%, higher end of the 2 to 3% expected range. FMCG revenue was slightly subdued because of tough demand conditions, so 5.4% versus expectations of 7 to 8%. Hotel revenue 12% versus expectations of 10 to 12% on a high base. That's a positive. And agri business, on account of trading in leaf tobacco as well as value-added agri products, that revenue of the agri business rose by 47% and much ahead of expectations of 10 to 15% growth itself. Paper business also arrested the decline but was still weak at 2% itself. Management has called out some resilience in demand, especially in the tobacco business, but there is some toughness in raw material environment with demand conditions, especially in the FMCG pack. So these things will be monitored going forward. In terms of valuations, ITC after falling yesterday was at around 26, 27 times, a lot more value accretive than all the other FMCG companies that had disappointed on growth, which explains why the stock has seen a bit of a bounce back today.
Okay, yes, that's the tale of 2 stocks, one in the green, the top Nifty gainer, and the other one seeing a sharp fall, that is IndusInd Bank. Thank you.
HUL is the top Nifty, one of the big losers week to date. It's down nearly about 7%.
They
also
spoke
came out
about the commentary, right? The commentary across FMCG space has been like that, and when the biggest FMCG company says that, of course, you see that kind of a reaction on the stock, and the stock was down 5% after the company reported results.
Yeah.
So, anything that is doing well is getting rewarded in an environment like this. But we'll do one thing. We'll take a quick break. Management of Birla Corporation will join us on the other side to discuss the Q2 numbers and the way forward. Stay tuned.
Welcome back. Now above 24,200. At the day's low, the Nifty was closer to 24,100. So there has been a little bit of a pickup in the market. But again, in context of the overall fall of 200 points, it's not much. The mid-cap index is still down close to about 1,000 points. But let's get a corporate conversation going. Birla Corp has reported a weak set of Q2 numbers, but mildly better than street expectation. The costs were lower, particularly the power and the fuel costs. The volume has declined 5% on a year-on-year basis, but the company remains cautiously optimistic about the coming quarter. We have with us Aditya Saraugi, CFO of Birla Corp, joining us on the show. Thank you very much for joining in. So the first question is on the volumes. For the first half of the year, you've degrown by nearly 2%, and it appears that you're shifting your attention more towards profitability versus market share. What is your guidance on volumes? And what will your market share now stand at? Guidance of volumes for this year, second half of the year and FY26.
Yeah, so thank you for having me on the show. Good morning.
Good morning. Thank you for joining.
Yeah. So in Q2, the volumes were quite tepid because of one, monsoon. Secondly, the government spending was also held back. So we expect those factors to reverse. And in the second half, in fact, we are expecting a smart recovery in terms of volumes and demand. So we are expecting our volumes to be at nearly 9.910 million tons in the second half, which will mean a growth of about 18% compared to the first half.
Okay, so 9 to 10 million tons is what you're expecting in the second half. That would take your total to around 17 to 18.38 million tons.
Yeah, 18,
Okay.
slightly around 18 million tons.
Okay, this compares with FY24 volumes of 17.61 million tons that you did.
Correct.
Okay, so you are saying that there has been a recovery in government spends, which was not the case that you saw in the first half. But what has the demand been like post-monsoons, Mr. Saraugi? Is there any sign of slowdown in the activity, or that has improved as well, especially in your core markets like UP and MP?
No, we are expecting a gradual recovery. We are seeing a gradual recovery in the market in terms of demand. The prices have not moved much, but in terms of demand, definitely we are seeing a gradual recovery. And post-Diwali, we expect the demand to pick up even further.
How much higher would it be, Mr. Saraugi, say if in monsoons it was X? How much higher are you seeing demand increasing in the second half? Have you seen it already so far in Q3?
Already we are seeing some recovery, but we expect the recovery to gather pace post-Diwali. And on that basis only, we are expecting the volumes to be significantly higher compared to the first half.
But sir, for the full year, you would still be at a growth of about what, 2 to 4 odd percent. Your best case is full year volume growth.
Yes, between 3 and 4%. Correct.
Okay. But this comes on the back of, a fairly muted year that you had in FY24, when I think you're, can you give us a little longer picture in terms of what kind of volume growth the company is going to see going ahead?
See, it is really dependent on the industry. If the industry grows at, let's say, 7 to 8%, we should also grow in that region, plus minus 1%.
Okay.
Okay,
Yeah.
Let's talk about your EBITDA per ton, Mr. Saraugi. You're guiding for a recovery in the second half. You've spoken about recovery in demand as well come by in the second half. What are you factoring in on higher realizations and low cost? Like, what's the EBITDA per ton that you're looking at? First half, it was 532 rupees per ton. What is the number for second half, and what will you end the full year with?
So, in the second half, we are expecting the EBITDA to be higher by about 170 rupees compared to first half. So that will take us to around 700 rupees in the second half.
And what would the reason be for that? What are the triggers?
Yeah, the trigger would be mainly higher volumes and better realizations, and we expect the cost to be benign. So the cost should be flattish.
Okay. So what's the outlook on cement prices then?
No, cement prices definitely we expect to increase in the second half, even in this quarter and definitely in the fourth quarter.
By how much, sir?
So that would be about 200 rupees, between 170 180 rupees a ton.
That will be the improvement in the cement prices that you'll see.
Yeah.
Okay. All right. So let's talk about your capex plans, the net debt target by FY25 end. In quarter one, it was around 3,125 crore rupees. The spends were targeted at 700 crore rupees. Can you give us what would the numbers look like by the end of FY25 and FY26 as well?
I can tell you about FY25, it should be around 3,000 crores. In FY26, we are going to embark upon the next phase of expansion to 25 million tons. So it is slightly premature to give an exact number on that.
So will that increase your debt? How are you planning to fund that expansion plan that you have in place?
That will be a part of accrual, internal accrual as well as debt. We have got some treasury assets also, 750 crores of treasury assets. We have got some non-strategic investments. So that also we can use. So it really depends.
And what would be the fresh capex starting FY26 of 25 million tons? How much do you anticipate you will require?
For the entire 5 million tons? That will be spread over a couple of years. But maybe that will be around 4,000 crores.
And spread over how many years, according to the initial estimates?
2 years. 2 years.
2 years.
Okay. Yeah. Mr. Saraugi, one trend that's happening in the cement industry for the last couple of months definitely has to be consolidation, right? The two big players going ahead and doing all those acquisitions. Is this impacting you? Is it impacting the other players in the industry? Are you all losing market share? If not a longer-term impact, are you seeing a near-term impact on the industry in terms of realizations and market share?
Not really. In fact, all the players are holding their ground. So I don't think it is impacting the market share in any respect.
Have you lost market share, sir?
No. We are around the same level. Maybe in some market there is a marginal loss, in some market there is a marginal gain. So on the whole, there is no major difference, I would say.
Mr. Saraugi, if there is some offer that comes to the promoters, the one that came for Orient Cement, for the similar offer for Orient Cement, do you think they would go ahead with it? Is this something that you would be open to?
Well, it will not be fair on my part to comment on that. But as much as I know, my promoter will not be interested.
Thank you, sir, for joining in. That's the word coming in from Birla Corp. Q2 was a bit muted, but the management is expecting a recovery in volumes, expecting a recovery in realizations and the EBITDA per ton. And they are going to, they're planning a capex of nearly 4,000 crore rupees, which starts in FY26. The stock, it's a weak market, So the stock is down 1.9%. Get into a break. We'll come back and discuss market technicals. Soni Patnaik of JM Financials joins in on the other side.
Okay, so there was a mild recovery on the mid-cap index, but even that has been sold into, it's a 1,300-point cut on the mid-caps that we are looking at, and the Nifty is down 264 points. So good to get a technical check on the markets. Soni Patnaik of JM Financial Services is joining us now. Soni, good morning. Thank you so much for joining in. Well, what next? Do you think there'll be further fall from these levels? We have that important 200-day moving average on the Nifty. It's still some points away, but do you think in next few trading sessions we could see that level as well?
Hi, good morning, Sonal, Rima. Thank you for having me on the show. I think Nifty has entered a technically oversold zone today. However, we can see it's not able to sustain or, show any sort of recovery. I think it's best not to catch a falling knife. There's a possibility that it can test 24,000 levels and only may see a support from those levels. No signs of short covering yet in the index. So there's, even if it falls around to 24,000, it can recover from those levels. However, it will continue to face very strong resistance around 24,400 to 24,500 range. I think that's where the call writers have positioned themselves. I think it's just the levels to watch out for, remain hedged when it comes to indices. More concerning is Bank Nifty at this point because it has broken 51,000 of a major support. And, by doing that, it has opened gates towards 50,000 to 49,500 range. I think that's a bit more concerning than Nifty at this point because Bank Nifty has the space where it can actually go and test those lower level support. So I think both the indices, it's best just to remain hedged and look for any stock specific strategy from here on.
Do you think the Nifty will touch its 200-day moving average? Because we haven't touched it since, I think, the election day. Do you think markets are likely to go down to those levels? It's, I think, about 23,350 roughly. So we still have about 750, 800 points to go. Is that a level on the cards? And do you see a breach of that convincingly on the way down?
So, Rima, there's a possibility if we look at positionally, certainly the entire structure has gone quite weak. And, the way FIs have been reducing the long positions and increasing the short positions, the entire structure has become a sell on rise. So, any levels that we see which gives you a small pullback recovery, it gets converted into a sold. So, there's a possibility that it can test the 23,700 odd levels. And, that's there's quite a possibility that even the whole of November series continues to be quite volatile in these terms. So there's this pain of around the selling or the sell on rise pressure. That structure is going to remain for another 2 to 3 months on a positional basis.
3 months. Soni, any particular sectors which would contribute mostly to the fall that you're talking about from these levels? And what would your individual technical picks be in a market like this?
Certainly. So, Sonal, we've seen consumption space doing quite, weak on those charts, and it has been performing badly also. So, I think that level or that entire space, consumption and auto, these are the two sectors which may continue to add pressure to the overall index. I think only space, maybe a bit of a private banks that can give some sort of reform or relief from current levels. But certainly, I think, these two sectors would be highly watched out for, and there's more downside left on these space. So if you look at the stock-specific strategies, we come with a completely balanced approach from current levels. One would be a sell idea, one is a buy idea. The sell idea comes in on Titan. So Titan, we suggest here to sell November futures around the range of 34.70, 34.80. Keep a stop loss of 33.65 and look for targets of 30.50. The buy idea is in Bharti Airtel, but it's a buy on dip. So one can buy Bharti Airtel around 1660, 1665 levels. Keep a positional stop loss of 1619 and a positional target of 1730 to 1750 can be seen.
Thank you. Bharti reports numbers on Monday, but the earnings are usually post-market hours, so the reaction takes place on Tuesday. But it's expected to be a good quarter for Bharti Airtel. on the back of the tariff increases that telecom companies undertook in July. But let's talk about United Breweries, Bikaji and Radico Khaitan. All consumption names. Let's find out how they fared in Q2 and what it tells us about the consumer demand. Mankadam.
What it tells you about consumer demand is that, food and beverages are being consumed, especially the ones which have seen some niches, strength in niches. So, United Breweries, the stock is lower today, but if you look at the overall business, 27% jump in premium volumes. That's a big positive, largely because the company has been seeding that. The only reason why the stock is perhaps lower is because gross margins, while they improved 81 basis points quarter on quarter, they were still lower year on year, and the growth is still led by north and western parts of the country. South is where there was some trouble as well, even as the company is trying to increase their presence or increase their market share back in Karnataka. Bikaji, on the other hand, the highest revenue growth in the sector so far. The company is confident of maintaining their growth. Revenue growth came in at around 18.5%, with 16% comparable revenue growth ex of PLI, volume growth at 15% as well, leading to margins at close to around 15% and net profit growth of 15% too. Ethnic snacks did well for them, but sweets ahead of the festive season did even better with a 22% growth. Radico Khaitan, here's the result of the season: 21% revenue growth, EBITDA growth of 35%, margins closer to 15% with a net profit growth of 24% as well. There too, while the overall volumes declined by 2.5%, the prestige and above volumes actually increased by 12.6%. The revenue of prestige and above increased by 18%, and their contribution to the overall sales increased to 75% as well. Add to that, the management is confident of double-digit growth in their prestige and above volumes for this year itself. So good commentary coming in, good growth for beer, Bhujia and Rampur.
There, Bhujia and Rampur. Everyone is consuming everything. Thank you so much, Mangalam, for joining in with those details of some relief in the FMCG space. But it's time for a short break now. Sanjeev Asthana from Patanjali will join us on the other side to discuss their Q2 numbers and the way forward. Stay tuned for that. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Let's get another corporate conversation going now. Patanjali Foods, that's the stock on our radar. The company's revenue and EBITDA overall came in higher YOY, but the food and FMCG EBIT for the company came in 39% lower YOY. To discuss this and the outlook for FY25, we are now joined by Sanjeev Asthana, the CEO of Patanjali Foods. Mr. Asthana, good morning. Thank you so much for joining in. I wanted to understand the recent change in the duty structure for edible oils. How has that changed things for your business? You had earlier indicated that edible oil markets are experiencing high volatilities towards the later part of the quarter. How has the quarter gone by after this change that has come by?
So the duty change has been very positive in one sense for the trade at large and the overall for the consumers as well, because the markets were under a lot of stress. So government took that, the step at two levels. One was to support the farmers with a big oilseeds crop coming. And second was to sort of bring it at a realistic level, which is at par with the international sort of value system overall, the way it is trading. It has been beneficial. So, the companies got one-time sort of gain towards towards almost like 15 days in September. But broadly, it sort of equalizes, because then the overall sort of market prices also tend to, adjust themselves to the changes in the duty. And partially beneficial, I would say, but it augurs well for the company now in the next quarter, because some of that gain that we'll carry forward. And our margin profile on the edible oil has become pretty consistent. So, for example, in the first quarter, also the margins on edible oil were 4%. Right now, also it's 4% plus. So we're hopeful to carry this momentum forward and keep building on, the good work done, sort of at the company level on the edible oil financials.
But Mr. Asthana, do you think Q2 volumes on the edible oil side slightly fell short of your expectations? Because I think the expectation was that you'll grow closer to 6%. You've done 4.5%. Even at the EBIT level, the expectation was about a 250 crore quarterly run rate. You've come in at 200 crore. Did it fall short of your own expectation? And for Q3 and Q4, what can you guide on volumes and EBIT?
So on volumes have grown, you're right. The volumes are target typically, we always give a range of 4 to 6%. So 4% plus is a good volume growth. The country is growing at typically between 2 and 3%, the overall demand side. So we're pretty comfortable with that. And I've often said that before, our focus is not so much on the volume growth alone. It has to be the quality of growth that we're working on. So it should be profitable, it should be structured growth, and we want the quality of margin to maintain. So if we do anything north of 4%, it's very positive. And that is something which we aspirationally would look at. We don't want 10% margin. We don't want to look at 2%. 4% plus is the kind of range that we're quite happy with.
So even for Q3 and Q4, 4 to 6% is the quarterly volume run rate we should expect. And do you think, given the conditions right now, we could be closer to the lower end?
So volume growth is actually pretty robust for us. So there's a bit of consolidation that has been undergoing in the edible oil market. We're witnessing almost nearly for a year now, where sort of the larger players have tended to benefit a lot on account of the macro factors. So I am expecting a growth range of 4 to 6%, the continued sort of momentum. And margin profile north of 4% is what we are sort of, giving as a guidance.
That's the edible oils business. Mr. Asthana, the big conversation that has been going around is the demand issues that some of these segments are facing in the FMCG space, generally in the industry. Tell us, what has it been like for you in the food and FMCG business? Because we've seen a revenue decline of 7.5%, EBIT decline of 39%. What is the outlook here? Will the second half look better? What will you end the year with?
So it has been a challenge. There's no question about it. In fact, we just finished our investor call, and this was the main concern everyone sort of raised. We are distinctly seeing some decline in the urban demand. Rural continues to be robust for the last 2 quarters. And the way, multiple different sort of support that is being provided, I believe that we will continue to see the momentum on the rural side. The urban, sort of the cities, the demand side, we're seeing some bit of tapering off. I mean, the factors could be, could be the food inflation, could be the factor of some stress overall on the demand side. It does not appear to be hugely significant, but it is certainly cause to watch out for and work towards. So we are seeing that, growth-wise, if we can maintain anywhere between 8 to 10% overall, and especially in the high margin categories. So there, for example, the Indian ethnic foods category that we have, we've seen fairly robust sort of growth. So we'd like to see that the higher end categories, which are higher margin, which provide, a good push to the company's financial. If we can keep seeing the good growth momentum there, and certain staples categories and others, if we see some bit of lower demand, then we are quite happy with. But overall, we have to watch out for the urban demand, because clearly that's a source of some concern that's beginning to show now.
This 8 to 10% guidance is for the full year, or is it for the FMCG, the home foods business?
It's only for the FMCG part of it. So clearly what we are, we'd like to do that. And still we believe that, there are spaces and areas where, we continue to sort of push. And for example, our biscuits, sort of volumes have grown, our revenue has grown just about 5.5%. Ethnic food volumes have grown way better.
But, so in Q2, I think the FMCG business revenues declined quite sharply, right? And you're still confident about an 8 to 10% top line growth for the full year?
Yeah, so we're reasonably confident that for the year, we are getting into the peak seasonal demand. A lot of our products typically, tend to do way better in the third and fourth quarter. So especially in the Indian ethnic food side, that will continue to build on the momentum. We are seeing demand, coming back, for our biscuits and confectionery. Again, we are getting into the peak season for Nutella. So there's some bit of seasonality into the product portfolio that we have. So the second half of the year tends to do better than the first half. And that's where we're looking at between 8 to 10% growth.
All right. Thank you so much, Mr. Asthana, for your thoughts today and what the outlook is looking like going forward as well for the industry and the company as well. That's the word coming in from Patanjali Foods. The stock is down 4%, and that's the situation with the market today as well. But for that, we will slip into a short break. As we do that, CNBC-TV18 celebrates 25 years of excellence. We invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit, bringing together visionary policymakers like RBI Governor Shaktikanta Das, industry leaders like HSBC India's Hitendra Dave, Kotak Mahindra Bank's Uday Kotak, and trailblazing startup founders. This is where the roadmap for India's next 25 years of growth and global leadership will be charted. You do not want to miss this.
Welcome back. Still down 1%, still down more than 2% on the mid-cap index, with the banks underperforming. The Nifty bank is down 2%. But market veterans are not very worried about the recent slump, though we have corrected 8% on the Nifty from the recent high and 10% on the mid-caps from the recent high. They're calling it a much-needed healthy correction. Now, speaking to CNBC-TV18, Randev Agrawal said the earnings slowdown is a temporary blip. He expects the markets to double in the next 5 years. Navneet Munot of HDFC AMC says he still sees some froth in the small and the mid-cap stocks, but adds that while there is an earnings slowdown being seen, balance sheets are still very healthy. Listen in to this important commentary, and thank you for watching this show.
It is the healthiest possible correction and overdue correction, I would say. And even if a bit more, I feel it will be deeper the correction, better it is for the people, because the expectations were going wild. You know, some people are saying that I want only 2-3% monthly return, month on month, that too compounded. So, you know, that expectation was running wild, and once the expectations are way beyond, see, ultimately, even last 5-year return is just about 16% of the Nifty.
Next 25 years look even better. Notwithstanding this correction, and we can discuss more about it, I don't think that the last few days give you any reason to worry about the next 25 years. This was expected. This is a healthy correction. There's the pace at which the money is coming. And the best part is a large part of that money is coming in the form of SIPs. And the 24,500 crores is, ticket size is 23 or 400 rupees per month per ticket. And that makes us very positive about the structural aspect of financialization of savings in India.